Hello, guys. My name is Joseph Ejike Oji. Tonight, our topic of discussion will be how inflation affects the value of investments. Let's begin. Now, it is very important to understand the effect of inflation. Inflation in general is very crucial to investing because it can reduce the value of investment returns. So, generally speaking, the rate of inflation is represents the rate at which the real value of an investment is eroded and the loss is spent in spending or purchasing power over time. So it shows you how far the value of investment returns is reduced, and also it shows how it tells us the extent of the loss and the spending or purchasing power over time. So now, we'll be looking at how inflation affects stocks and bonds. Let's look at bond first of all. Now, to bondholders, inflation is considered to be public enemy number one. Uh, Now, as we all know, bonds are fixed rate investments. And what are bonds anyway? Well, a bond is like a loan to the government or to corporations. Let's say that the government wants to raise money to build a road project. Uh, so if the taxes they collected cannot uh, be enough for that project, they will sell bonds to the public. So when you buy that bond, the government, when they sell that bond, they promise to pay maybe 5% or 10% or 2% return on the bond. Call it 2% yield or coupon. Now, so that means, assuming that the bond is 5-year bond, that means the government will pay you back in 5 years' time. If it's a 10-year bond, they pay you back in 10 years' time. Similarly, if it's a corporation bond, that means let's say that Apple wants to build a new type of iPhone. So they need money to do that project. They call it research and development. They can sell bond to the public. Now, we buy that bond. If it's a 5-year bond, then they pay it back in 5 years. This is how it works. They say, okay, the coupon payment for this bond is 5%. That means every year or twice a year, they pay you 5% of 5,000 of that amount that you invested every year. They pay, or twice a year they pay you their money. Then when the duration, the maturity of that bond, which can be 5 years or 10 years, they pay you back the whole money they borrowed plus another payment or year, what they call yield, that bond. So when you buy the bond, in other words, you are lending money to government or you are lending money to the corporation, whichever agents that have that bond. So how does inflation affect bonds? Well, inflation, if inflation is increasing, that means that the return on a bond will become reduced in real terms, which means that inflation reduces the value of those returns. Let me show you how it works. So suppose that a bond pays 4% yield. So that means that means you are receiving 4% of in that investment. But if the rate of inflation is 3%, that means the value of investment will be reduced, because even though you receive 4% in return, but the purchasing power for that 4% is only 1%, because you have to factor in the effect of the inflation. So let's say that mathematically, let's say that yield, how much you earn from the bond is 4% bond yield, and the inflation is 3%. So the real bond rate will be bond yield minus inflation, which means 4% minus 3% is 1%. So even though you receive 4% yield, the value of that investment is only 1%. So that means inflation can catch up with the years in their bond years and make your investment almost valueless. And because of the fact that the yield in some bond is not as big as it should be, bond inflation became it makes investors to be very paranoid. Yeah. Especially whenever it like this period of this time when we are facing high inflation across the globe. Let me show you how bond yield looks like currently. For example, Bloomberg can be a good source. You can see the fixed income indices, so different bonds. Okay, see, let's use a 10-year government bond yield. Yield for United States 10-year bond is 3%, and the current inflation we have now is almost, I think it's almost 5% or even more. So when you invest in this, you're actually losing money because inflation have already eroded your return. Now, the more risky the bond, the more the yield. Like if you look at Brazil, they are more risky bonds because they have defaulted before in bond. So their yield is 13%. To attract you, so the bond is risky, but to attract you to buy it, they pay you higher yield. But US bond is US have never defaulted, so they're not attracting you. Naturally you want to buy it, so they pay you lower yield. And if you look at other countries, you can see Germany is 1.3%, United Kingdom 2.12%, France. These are the see very small yield. Company like India, which also have a risky bond, pay you higher. Okay, I think you get the point now. So you can see why inflation is very bad for bond. Now for stocks, inflation affects stock differentially depending on the type of stock. If it's a value stock, then they perform better when the inflation is high. Now, when we say value stock, we mean stocks of companies that are currently trading below what they really worth, and will thus provide a major return, a superior return. Let's say that the stock is trading at $20 per share, and but it is what the actual worth, how much it will be in the future, can be up to $40 per share. So that kind of bond stock, inflation does not affect it. It favors them because inflation means increasing price, and the bond price, value stock is going up. Example of company that we consider value stock: a company like Citigroup, ExxonMobil, which is an oil company, and JP Morgan Chase, which is a bank. Now, growth stock perform better when inflation is low, and we call them growth stocks because they are companies that are expected to grow their sales and earnings at a faster rate than the market average. But in both cases, we figure out whether a stock is a value stock or a growth stock by computing their price earning ratio. I have taught you how to compute price earning ratio in the past, so you can watch my video on stock price earning ratio, how to compute it. So why does value stock benefit more from inflation? One, when in general, in high inflation periods, future earnings become less valuable and current earning becomes more valuable. Now, since value stocks are valued at their current earnings, so it follows that naturally that inflationary periods will be better for them than for growth stock. That's why. Now, at this point, I want to show you mathematically how this works with respect to computing the future value of an investment. So now, to show the effect of inflation, or to factor in the effect of inflation when calculating the future value of an investment, we first of all compute what is no. We use what we call net differential compounding rate. Um, so this can be found by subtracting the expected inflation rate from the stated interest rate. So now let's see. Formula is this: differential compounding rate is the stated interest rate minus the expected inflation rate. The interest rate in this regard means the earnings, how much you make, as a percent in percentage value, percentage representation of how much you make from that investment, minus the expected inflation rate. For example, if the interest rate is 10% and the inflation rate is 3%, so if an investment is compounded at a differential, well, in that case, if the interest rate is 10%, that means the return that you expect to get from that investment is 10% of the value, and the inflation rate is 3%. So in that case, the differential compounding rate you use to value your investment will be 10% minus 3%, which is 7%. So instead of using the actual return of 10% to value your investment, it's better to use the differential compounding rate so that it tell you exactly what your investment will worth, instead of using a regular rate and not factoring in the effect of inflation. Let's see how this works. It says here, you are planning to invest $5,000 for today for 3 years at a nominal interest rate of 8% with annual compounding. So what you are expecting to gain from that investment is 8%. Now you say, what will be the future value of an investment? Then now assume that the inflation rate is expected to be 3% per year over the same 3-year period. What will be the investment future value in terms of the purchasing power? Now, what will be the investment future value in terms of purchasing power if the inflation occurs at 5% annual rate? So basically, this question wants you to calculate the future value without inflation being factored in. Then also, part B and C, we are required to factor in the effect of inflation and then calculate what your investment value would be in terms of the purchasing power. Okay, now again, we are going to use Excel. The formula is future value, interest, number of periods, payment, present value, and time. So let me write this down so that I won't be going back and forth when putting it in Excel. First of all, our investor, the interest rate is 8%. Interest is 8%. Number of years is 3 years. 3 years. I'm going to put all this in Excel, so don't worry, I will show you everything. And then have the amount. So sorry, my payment. There's no payment, so you won't get it. You receive any payment until the end of 3 years. So payment is 0. As for this PMT, present value is the amount you invested. Now since it represents money leaving your pocket, it's gonna be a negative. So negative 5,000. Then type, you receive your earnings, the interest at the end of the period. So you use 0 type. So let us go and calculate how much. So let us go and answer part A. Please, part A say what will be the future value for investment. I'll take you to Excel so you can type this in. Okay. Hope you can see it. Yep, got it. Interest is 8%, so 0.08. And number of years is 3 years. Okay. Yeah, 3 years. Payment, there's no payment until the end of the 3 years, so no payment. Present value is how much you invested, which is 5,000. 5,000, since it represents money to be in your pocket. Type, well, you'll be paid at the end of 3 years, so put 0 for type. Now let's calculate how much your investment will be worth in 3 years at 8%. Equals future value, which is FV, see the rates, 8%, comma, number of period, MPER, that is N, 3 years, comma, payments, no payments, 0, comma, present value, which is the amount invested, comma, the type, see, for 0 for the end of period, so 0, end of 3 years. Close the parentheses and press the enter key. See, this is how much your investment will be, you know, in terms of future value. This is how much you will receive. Okay, so for a gain of now you invested, this is how much you made, right? Click on that. Oh, excuse me, gain, put equal sign first. Gain of this minus how much you invested, 5,000, right? Okay. Now I can't. That's 5,000. 5,000 because I have a negative sign here, so I'm going to just type in 5,000 so it won't give us the wrong result. Again, it's $1,298.56. It's again. So I'm going to use green for that, since you know, just to make it different. Now, let us repeat the same process because part 2 says, part B says, what now? Assume that the inflation rate is expected to be 3% per year over the 3-year period. What would be the investment future value? See, in terms of purchasing power. Okay, good. Now we can now put our number. Interest is still 8%, 0.08. Now the rate of inflation, I might stay there. Oh, excuse me. Okay. 0.08. Okay, I want to make sure. Interest is 0.08. Then inflation rate is 3%. I wrote here 3% inflation. 0.03. So that's, let's find the differential compounding rate. Remember, the formula for differential compounding rate is the stated interest rate minus the expected inflation rate. So our own stated interest rate is 8% and the expected inflation rate is 3%. So that our differential inflation rate, compounding rate, will be equals to 8% minus 3%. It was 5%. So this is what you use as a rate when you are calculating the future value for this investment. So number of years is 3 years. There's no payment in between except at the end of 3 years. Present value is the same 5,000. Okay. Okay. Yep. Same 5,000. Now type 0 because you receive the money at the end of the period. So future value now becomes future value FV opening parenthesis. You have rate is, so instead of using 8% this time, you're gonna use 5% since you have to subtract the inflation rate, comma, number of period is 3 years. Click on that, comma, payment is no periodic payments, comma, present value is 5,000, comma, type is 0. Okay, close parenthesis and press enter key. See, this is 5,000. Okay, 5,788. So instead of making 6,000, well, you make $6,000, $6,298.56, but the actual value will be 5,000 because of inflation. So you made this money, but it is worth only $5,000. So that your actual gain under 3% inflation, okay, will be, okay, I mean, okay, there will be equals. We have the amount you invest in, you made as gain minus $5,000 that you invested. So your actual gain is five. This one 5. So you can see the gain, how the inflation have eroded their gain. So $788. This is the value, even though this is actual monetary amount that you gain, but the worth is $788.13 because of inflation. Now, if its inflation is 5%, now since we have done the calculation, we can just copy this and paste it here. All we have to do now is to change the inflation rate to 5%. Okay. Now let's do it. So I want you to watch here as we change it. So let me type in 5% inflation. Okay. So you can see how I want it changes. Now for this one, for 5%, that is for part 3 of the equation. It says what should be the investment value in terms of purchasing power if 5% annual rate of inflation. So the one I got before is 6,298, as you can see from here, 6,298. And the second one is 5,788.13. You can see that I have the same thing in my PowerPoint presentation. You can see that here, 5,788.13. So for 5% inflation, we do the same thing. All we have to do now is just to change the inflation rate here to 5%, and it will recalculate it for us since we have already calculated it. So the formula is still there. So I change the inflation rate to 5%, which is 0.05. I want you to be watching here as I'm doing it. You can see that it will recalculate it. 0.05. So once to remove this, see, it went down again. Okay, by itself. So for 5% inflation rate, we have this here. I can put it right there. And say this minus 5,000 we invested. So even though our yield, or what we have, surely is in monetary terms, is 1,298, the real value in terms of purchasing power is only $430. So the value of our investment keep going down with inflation. Now for 7%, now I added 7% just add it by myself. So suppose the inflation reaches 7%. Okay. In that case, we just have to copy this since we have already calculated it and replace it by 7% inflation. Let's see how it will affect our value of our investment. So we just change this to 7%, 0.07. And that's, please watch here. You can see that it will calculate it again. See, 5,151.51 cents. So for 7% inflation. So you can see why investors are so worried of inflation. When the consumer price index are announced and it shows that the price are going up, you see the bond yield being affected, or even stock price become affected because investors are so scared of inflation. So the value now, in terms of the purchasing power, now becomes minus 5,000 that you invested, only $151, even though the gain in monetary terms is 1,298, but it's only worth $151.50. So this explains how inflation affects the future value of our investments. So I hope you enjoyed my lecture tonight. In the next lecture, we'll have we'll be having present value. We start with present value of an investment, which is basically the value now. Especially if you want to buy investments, or maybe say a property, and somebody might ask you, say you want to sell that property for 200,000. You might say you yourself can do your own due diligence research to get the actual value of that property now. So tomorrow the next lecture we'll be working on that. Like I said, I hope you enjoy this. If you enjoy this, please don't forget to subscribe to my channel. I see you in my next lecture, and have a good night. Thank you.